Hello, I'm David Glascott and welcome to this update on the Prime Value Opportunities Fund, which has just celebrated its 3rd year anniversary. Today we'll be speaking with St. Wong, Chief Investment Officer and Portfolio Manager for the Opportunities Fund. But before we do so, let me give you a brief update on the parameters surrounding the fund's objectives. Note the fund has the flexibility to move to a high cash position if the portfolio manager feels it prudent to do so. As well as this, the fund also has the flexibility to move to an up to 20% international equities holding, which would predominantly be out of Asia. Let us now introduce Portfolio Manager St. Wong and get his insights into the markets and how the fund is performing. St. The Opportunities Fund has just had its 3rd anniversary and the performance has been very strong over that time. Just remind us as to why you developed the fund in the first place.
Thanks, David. We started the fund 3 years ago when markets were starting to recover from the GFC. There was a clear need from our investors for funds which focus on positive absolute returns rather than one which focused on a relative return. From that perspective, we had a clear alignment of interest with our clients because Prime Value as a firm have focused on absolute return for 18 years now. So this fund is specifically designed to cater to that need, and we think this resonated substantially with our investors. Now, to help us achieve our objective of returning positive returns, we have 3 levers. First, we hold a portfolio of 20 to 30 stocks in a portfolio, quite concentrated and clearly designed within a well-diversified portfolio. Secondly, we are in a position to move our portfolio holdings to cash if markets enter a period of stress or weakness. But finally, from our perspective, international stocks make sense for us. This option gives us choice, increases our investment opportunity set, but most importantly, it also helps us diversify our portfolio. But the thing which most excites me most is really it gives us the opportunity to participate in structural and cyclical changes in Asia.
It's interesting that you have an 8% mark as your absolute return benchmark. How did you arrive at that benchmark number and how has the fund performed against that benchmark?
The long-term average return of the Australian market is 8%. We believe it's a sensible benchmark to hold our performance against, especially within a context whereby we're looking to achieve positive outcomes for our clients. The fund has returned 15.8% per annum over 3 years since inception, and as a result, we are comfortably above our 8% benchmark. I think more importantly as well, David, is to highlight that during that 3-year period, the ASX 300 accumulation index posted a return of 10% and a small lots accumulation index was virtually flat. So we've outperformed benchmark on all accounts and certainly much better than the broad indices that investors do look at.
They're impressive numbers, St. Well done. The Opportunities Fund has a unique take on portfolio construction. Can you tell us a little bit about how you do construct the portfolio and how your 5 categories fall into that?
David, we construct our portfolio around 5 categories: core companies, specific growth companies, turnaround companies, companies residing certain thematics, and finally valuation companies. Each of these categories account for something quite different and we're looking for something quite specific. For instance, core companies for us are companies which are going to give us sustainable earnings going forward, but more importantly, they hold well-financed balance sheets. In that way, they can act both defensively and offensively, especially when acquisitions are concerned. Specific growth companies, for example, are companies which perhaps be producing interesting services or products where we think demand for such products or services is high. In the past, we would have invested in IANet, for example, as an exposure to such a category. Valuation companies are companies which are obviously trading below its intrinsic value, whether the market's somewhat short-term focused, for example, and we think in the long term there is value in such companies. But turnaround companies, for example, as the name suggests, are companies within a turnaround situation. Companies such as Suncorp, for example, or Wesfarmers, we would categorize that as a turnaround company. The most important aspect in these companies, David, is that the structure of these industries are working in the favor of these companies. It makes life much easier. It makes turnaround much easier, and as a result, we think shareholders will be major beneficiaries of this scenario. The final category that we have within the portfolio, or we construct our portfolio around, is thematics. Thematics could be long-term structural thematics such as consumption, or wealth creation in Asia perhaps, or urbanization in Asia. And companies such as Sydney Airports, for example, fall into this category. So these are important factors for us. We construct within 5 categories. It helps us, number one, most importantly, identify specific criteria for us to lay out an investment perspective or investment thesis. But secondly, as a portfolio construction process is critical. The Australian market is highly concentrated. Banks, resources account for a substantial part of our index, and as a result, it's critical for us to address that situation. Forming our portfolio around these 5 categories help us address the concentration risk that investors hold. This gives us a wider investment choice, investment set, and also helps us to diversify our portfolio. The end outcome, therefore, David, is a more robust portfolio, and we think this has been delivering outcome for investors over long term.
ST, at a more strategic level, what are the major themes you're looking at the moment, both from an Australian perspective and on the global stage?
We are very interested in demographic changes in Asia. Urbanization, wealth creation in Asia is resulting in higher spending in travel and leisure. As a result, I've got an investment in Sydney Airports. 1/3 of the world's population sit within a 6-hour flight to Sydney. Sydney Airports has a key asset in its holding, which is the airport facility. As a result, spending on travel and leisure is increasing amongst Asian consumers. Sydney Airports is primed to benefit out of that, and for that reason, I have an investment in Sydney Airports in my portfolio.
That's an interesting thematic, ST. Can you give us any other examples of companies that you are following or in fact are in the portfolio at the moment?
We recently invested in Baby Bunting, Australia's largest retailer of baby goods. It holds 31 stores and is looking to expand to 70 stores. The key opportunity for investors, David, is that a number of stores at Baby Bunting are quite immature, having only recently been opened in the last few years. And as these stores mature, like-for-like sales for Baby Bunting will increase. This will underpin not only sales revenue growth, but certainly margins expansion in the business. So Baby Bunting fits into our category of specific growth. It operates as a dominant retailer in this niche category, and earnings will be underpinned by the fact that immature stores will become mature, underpinning revenue growth going forward. We expect earnings growth to be quite robust in the next few years.
So finally, ST, what's the outlook from you for 2016, and how is the portfolio positioned to capture any upside from this?
The broader macro outlook is actually quite soft. The Australian economy is going through a soft patch. Resources companies looking at commodity prices headwinds. Industrial companies are looking at quite intense competition, and as a result, margins are actually declining. Having said that, David, the market continues to trade with very low interest rates, and that's really positive for equities in general. Where we're most excited with is the mid-cap sector. Not only are earnings at the mid-cap sector much stronger, superior to large cap sectors, but the diversity within that sector is really interesting. As a result, for stock pickers such as Prime Value, is really opportunistic for our fund to begin to throw through some of our investment pipeline in the mid-cap sector. So in 2016, we expect further diversification of our portfolio. We think the ideas will be eclectic, it will be opportunistic, it will be very much focused on the mid-cap sector. This is where we think we'll be looking to deliver positive outcomes for our investors into the next 2 years.
Thanks, ST, into that insight into the fund. At Prime Value, we value feedback. And if you have any feedback regarding anything that ST said today, or in fact anything to do with Prime Value, please contact us. Once again, thank you for your time, and we look forward to speaking to you again soon.